This chapter 3 delves deeper into the meaning of a forward interest rate and examines some basic trading strategies involving views about the likely accuracy of forwards. Perhaps the best way to understand forward rates is to consider the following one-year trade involving a choice between the 1-year and the 2-year zero coupon alternatives. Under the first strategy, you purchase the 1-year note, which yields 5.26%, and you simply hold it to maturity. Whereas under the second strategy, you purchase the 2-year zero coupon note to take advantage of its higher yield of 8.11% and plan to sell it after 1 year. Strategy 1, of course, has a predetermined return of 5.26%. Strategy 2's return over the 1-year holding period will depend on what is the 1-year discounting rate in 1 year's time, i.e. when we come to selling the investment. We will be referring back to worksheet 1-year forward from time to time, so you might want to keep it open. Let's examine alternatively what happens if, as shown in this table, the 1-year interest in 1 year's time is 10% under what we have called here scenario 1, or 12% under what we have called scenario 2. Under either of these scenarios, of course, our entry price is the same, namely 85.56%, and this is nothing other than DF2, since we are buying a 2-year zero coupon note. The exit price, however, will differ and will be 100 divided by 1 plus 10% under scenario 1, but 100 divided by 1 plus 12% under scenario 2, as you can see in the row for the exit price. We then proceed to calculate for these two scenarios the all-in return in the row underneath and compare for each scenario its performance relative to the definitive outcome of strategy 1. In essence, while the relevant interest rate, i.e. the 1-year interest rate, has increased substantially under both scenarios of strategy 2, going from 5.26% to 10% for scenario 1 and even to 12% for scenario 2, strategy 2 still outperformed strategy 1 by a substantial margin of 100 basis points when this 1-year rate had risen but only to 10%. Conversely, strategy 2 in the second scenario underperformed strategy 1 by almost the same margin, or more specifically by 90 basis points, when the 1-year rate had risen all the way to 12%. The approximate symmetry of these two outcomes under these two scenarios suggests that somewhere around 11% we might find the break-even. That is to say that if on the exit date the 1-year rate is 11% or thereabouts, the two strategies, strategy 1 and strategy 2, might turn out to be identical. A quick glance at worksheet 1-year forward reminds us that the 1-year forward 1-year rate is in fact 11.04%, raising our suspicion that at this exact level for the exit discount rate, the two strategies will turn out to be identical. This is indeed the case for under this third scenario, which we here designate as scenarios 3, our preceding table can now be expanded to look as shown here, and confirming that under this third scenario, the exit price derived from discounting at 1104 gives us an all-in return in this final column on the right of exactly 5.26%, therefore matches exactly strategy 1. You should be able to prove this result algebraically if you are so inclined, but we will skip this step in this module. More generally, it turns out to be possible to prove mathematically that if the yield changes implied by the forward rates are subsequently realized, then all zero coupon bonds, regardless of their maturity, earn the same return over any holding period. And specifically in our example, and in particular in scenario 3, in which the 1-year forward 1-year rate, 11.04%, was exactly realized, the 1-year zero coupon investment and the 2-year zero coupon investment earned exactly the same holding period return of 5.26% despite their maturities. You may be able to anticipate the parallel to this principle, namely that if a bank funds itself and invests at different points of the same zero coupon curve, i.e., if it does not try to enhance yield by taking on credit risk or currency risk or any risk other than gapping risk, pursuant to which it deliberately mismatches the maturity of its assets and its liabilities, and if forward rates are subsequently realized, then the bank will break even, irrespective of which 2 points of the curve it chooses for its gapping strategy. Inevitably, this raises the question whether forward rates are indeed typically realized, or at least whether they turn out to undershoot and overshoot the eventual outcome by comparable amounts and with comparable frequencies. Few generalizations can be made on this point, given the enormous variety of yield curves around the world and the difficulties of stripping away entirely all other risks and leaving the bank exposed exclusively to the desired gapping risk. But for very short maturities in the US risk-free or the nearly risk-free curves, there does appear historically to be a fairly systematic tendency on the part of interest rate forwards to overshoot the eventual outcome. In other words, it is significantly more common for the eventual short-term rate to turn out to be lower than was implied by the forward at some defined earlier time than it is for this eventual short-term rate to turn out to be higher than was implied by the forward at that earlier time. In turn, you should quickly see that for as long as this remains true, the strategy known as running a negative gap, i.e. of lengthening the tenor of assets versus the tenor of liabilities will on average earn positive returns for the user on a cumulative basis over a long enough term. But of course, there may well be sustained periods of time in which the returns from this strategy are in fact negative. It is partly for this reason that most US banks are more likely to be running a negative cap than a positive one, although other factors play a role as well. In a sense, this result is consistent with the basic theory of investment risk and returns. Indeed, is almost inevitable under that theory, especially when you remember that the 2-year zero has a higher duration than the 1-year zero, and hence a higher price volatility. If forwards are on average realized, then an investor with a 1-year horizon would always opt for the 1-year zero over the 2-year zero in our example, as there would be no point in opting for the instrument with the higher price volatility if its average expected return from holding it is the same as that of the instrument with the lower price volatility. So in a very final sense, the 2-year instrument compensates for its higher duration and therefore its higher price volatility by offering potential holders a higher expected return over a 1-year holding period than its shorter competitor with the lower price volatility. This completes Chapter 3.